Well, this is certainly awkward, isn't it? Ladies and gentlemen, boys and girls, computers of all ages, I hope that you would like to see a program that will be informative, humorous, insightful, and not as boring as the last one. Well, unfortunately, it's going to be worse than the last one, and I strongly recommend that you not watch this program. If you do watch this program, then I recommend that you take 2 Tylenols and go to bed. In any event, the presenter is a lawyer in Clearwater, Florida, although it's hard to believe that he has any education whatsoever. If you have questions during the presentation, you're just out of luck because you really can't rely on the answers. So that is my introduction to a program that only gets worse. Well, thank you very much. I appreciate that hearty invitation. I'm Alan Gassman, and I am here to talk about new EstateView features and estate tax planning after the election. I'm here in our studios in Clearwater, Florida. We survived 2 hurricanes, floods, frogs, squids, and an election. I hope you're doing well. I know a lot of people were very stressed over the election. The election's over. It's time to make the best of life and to do the best that we can for our clients and our families. So that's what we're here to talk about. I've got PowerPoint slides that you can see. I am open for questions that you can post. Thank you for loving the puppets. I've already had 2 people say I love the puppets. There's nothing about loving the presenter, just the puppets. I understand completely. This presentation does not qualify for continuing education credit. If you need a certificate of attendance and you can get the credit on your own, that's fine. We'll be glad to give you a certificate. Also, I'm going to demonstrate EstateView estate planning software. And if you're interested in EstateView estate planning software, just send me an email. We'll be glad to tell you about how it came about. I thank Professor Jerry Hash, Bob Keebler, and Jonathan Blockmacher for their help and support in putting together this software. You do not have to subscribe to this software or to know anything about this software to get something good out of this presentation. Where are we on the Corporate Transparency Act? Well, we have till December 31st to register all companies, LLCs, limited partnerships, and certain other entities with the Treasury Department. If they're not registered, the fine is over $600 a day beginning January 1st. There is a 90-day reprieve for people who live in the hurricane areas. If you need the map for that, I can send it to you. Or if you can show that your advisor is in one of those areas and is not able to get the job done. There is speculation that because Donald Trump vetoed this law, although it was passed despite his veto by the Senate and the House, that it may be vetoed or pushed back again. They expected 37 million registrations, and from what I understand, there's only been at most 3 million. It seems like our office has done a lot of those 3 million because it takes a little bit of work, but a little bit of work because there's so many companies out there. But if you'd like, if you do buy you can get this on Amazon, or if you buy the EstateView software, you get these books. So I'm going to go ahead and open up the EstateView software here, and I'm very excited to show you a new component of EstateView that I think is going to change how you look at EstateView and how you use EstateView. It certainly changed it for me, and it makes it much more user-friendly, which was the most common criticism we got, was that it wasn't free. But the second most common criticism we got was that it was not very user-friendly. So we now have a button for the instant plan. I'm just going to make sure that my audience can see my cursor, my cursed cursor. Okay, there you go. Orange, you glad that you see my orange cursor? I'm going to click on instant plan. And if you're a subscriber, you'll see that this works. It's going to have more features added, and I'll tell you a couple things that aren't working yet. But you see a typical information entry portal. The first thing I told Kevin, our wonderful, brilliant programmer, is I don't want to ever hit the next box and be told, you need more information. This box wasn't filled in. See the asterisk. That does not happen with EstateView. We will just deal with whatever information you give us, and that would be the client's name and an age, whatever age you might decide, and male or female, which has to do with the life expectancy and whether we call them Mr. or Mrs. in our form letter, how much estate tax exemption they've used up. Everybody has a $13,610,000 estate tax exemption. That goes to $13,990,000 per person on January 1st, 2025. It is scheduled under the law to go to half of what it would otherwise be January 1, 2026. Do you think that that's going to happen? Before the election, I thought it might happen. I figured a 25 to 30% chance it would happen, but a greater chance that Democrats and Republicans would get together and keep it at 13,610,000 plus inflation. Now they would need the president, the Senate, the House, and to follow the Byrd rule, the reconciliation rule, this and that, hopscotch 3 times, jump on your head, put snake oil on it, and they could extend the Trump tax cuts. This is one of them. My prediction is they will, and the estate tax exemption will not go to half, but maybe next time or the time after that it would. So that's my discussion on that. I go to spouse number 2. In other words, this is a married couple. This isn't his second spouse. Maybe it is. I hope it's better than his first one. And we'll call that spouse Mary, and she'll be 61. Let's make her 59. And by the way, it shows me that Mary's life expectancy is 23.8 years. A 59-year-old female is expected to live until age 83. And then the joint life expectancy of someone Bob's age and Mary, one of them would live 27.2 years. So that's what we're going to use here. Then I can put down the name of their amazing CPA, amazing investment advisor, life insurance agents, emergency contacts, all that stuff. This will eventually be a portal. So if you're an EstateView subscriber, your clients can go to the portal and they can fill this out themselves instead of your normal intake form if that's easier. Then a few estate planning decisions, then the family information, children's ages, and it tells me the life expectancy of their 39-year-old child, and when their child under age 18 will turn 18, because I want to know that. Grandchildren, et cetera, parents can be important because you may inherit from them or you may give them a power of appointment to enable assets to get a new income tax basis on death, which we will talk about later on. And then I'm even going to ask them, your investments, what is the ratio of stocks, bonds, and cash? Because I'll be showing them a Monte Carlo analysis of potential rates of return, then investments outside of the IRAs, and the ratio of investments inside of IRAs with values. Is there a high growth asset? A lot of people come to us and they say, the reason I'm here is because my company, I could value it today at $3.5 million, but I think I'll sell it for $15 million in 2 years if things go well. What will your planning do for me? So we can go ahead and show that, and that's a way to show a high rate of return type of asset. Then this is nice. This is telling me that for Bob's life insurance, if he doesn't have enough, and if I'm going to recommend some, then if he needs 10-year term at his age with a 19.1 year life expectancy, 10-year term for preferred would be $6,000 a year. For standard would be $9,000. Now, these are just typical rates. We don't sell life insurance. This is just based on a survey that we took. Or a permanent policy would cost $38,000 a year for $1 million of coverage. I can click on add policy, and it's going to add that policy, and I can click on whether to put it into a life insurance trust or not. That's pretty simple. Then I can enter in his other policies that already exist. And then Mary's policy. I need to put Mary's age here. The next time you see this, it will show you Mary's age. So that's the life insurance. Now, once you have the life insurance information, it's going to provide a spreadsheet of life insurance and reminders and information about the life insurance, but that's not working quite yet. And then the next question is, would they consider a charity on the second death? And the answer, of course, is yes, because they're very giving people, meaning that they're going to give a lot of legal fees to do a lot of charitable stuff. That was a joke. Didn't hear anyone laugh. So they can go directly charitable, or they can go with a charitable lead annuity trust, or they may go with a charitable remainder trust. And an example of a charitable remainder trust would be if they have $5 million in an IRA and they're not so crazy about that coming out within 10 years of death, they could put it into a charitable remainder trust. It could come out over 20 years to spray the income out later, and at the same time get them an estate tax charitable deduction. So I'm going to click for a charitable remainder trust, and I can give it whatever name they want. Sam's Trust and Club Sandwich. That's a great name for a charity. And then I can have notes to the planner like, this plan is amazing, said the puppet. Oh, I didn't. Yeah, you did. Okay, so now I've got a review of their information, and this can of course click out, and then I go to results, because that's what people want, right? Results. So I click on results, and I am on the results panel. Across the top are all the different modes that I can go to. So first I'll go to family tree, and for my meeting with the client, I now have convenient to me the names of their parents, their children, their grandchildren, and their ages. Not a big deal, but it's nice to show clients that you've got the right information. It's better for them to correct the spelling and the ages at this stage than when they get the first draft documents. Then I can talk about the contacts. Now, I wear glasses, I don't have contacts, but most clients have contacts that you want to review. They may think of somebody else to add. And then I can talk to them about their required minimum distributions. People like to see their required minimum distribution information. So we know from our questionnaire, Bob is 65, life expectancy 19.1 years, IRA worth $3,750,000. It's growing at 7.5%. And this shows him his required minimum distributions, which will begin at age 73. By then, the IRA will be worth $6,700,000, and his distributions that he has to take out, $252,379. And then you'll see the value of the IRA goes up and up And even though the payments go up, right up through age 90, the value of the IRA doesn't start coming down until age 89. That's when it starts coming down a drop, and we're taking it to age 90. Now, the next time you see this, you'll see a line across the page at 83, which is the life expectancy. And then Mary's got a smaller IRA, and she's younger, so she's going to be able to build up, have no payments to age 73. Now, we'll ask Kevin to go ahead and show charity in this as well, but otherwise you just go to the RMD calculator and you can use the charitable. But I think it's nice. It really gives clients a sense of security that if things go well in their IRA, they'll have a decent rate of return. Now, the next thing we're going to have within about a week is a Monte Carlo analysis. So with the Monte Carlo analysis, and I'll just go to EstateView Central here. If I click on Monte Carlo analysis, what I'll be able to show them based upon the value of all their investments and what's in stocks and what's in bonds, I'll be able to show them, for example, across the top here, if we had put it 45% in bonds, 55% in equities, that's an S&P 500 for a 30-year investment, then the average would be 8.53% rate of return, but the top 10%, the bottom 10% would only get 6.43% rate of return or less. Let me close that lower one. And the worst 1% would get 4.75% or less. The highest 90% or the highest 10% would get 10.62% or more. And that's called a Monte Carlo analysis. Where it comes from is that the every year from 1936 to present, with this portfolio, we know what the rate of return would have been. The computer rolls the dice 10,000 times, 30 times 10,000 times, and every time it comes up with a number, and that ends up with what we call a standard deviation. So let me see here. Where am I going? So this shows you that the shorter the investment period, the more the rate of return will vary. So the computer rolled the dice 30 times and decided that the best 1% rate of return for 1 year would be about 20%, would be just under 20%. And the worst would be below 0. But if you look at 10 years, then the best rate of return would be about 10% in the 90th percentile, and the bottom 10 percentile would be about 10%. So that's a Monte Carlo analysis. We'll be refining that. And if I just change one thing, like I go to a 50-50 portfolio, the computer just rolled the dice 10,000 times. That's how fast it is. So I'll go back home and I'll go back to the instant plan and I'll go back to results. And the next thing I'll show you is what this client can do with a trust. Like the word preposition is everything a squirrel can do to a tree. Well, EstateView shows you everything a person can do with a trust. It's always rated G, by the way. So assume a $1 million transaction between a client age 70, that's the client's age, and a trust that is disregarded for income tax purposes. Now, what can I do with that trust? I could sell assets to that trust in exchange for a note of 3% or less and charge 3.96%. A 9-year note, if I do it this year, if I do it this month or in November, would be 3.67%. An over 9-year note would be 4.06%. Now, if I wanted a note that would cancel on death, I know that I could do a 15-year note, would pay interest to him at 8.1075%, and that would be an annual payment. And if he dies during the 15 years, there's no tax on that. Or he could put $1 million into the trust in exchange for a lifetime private annuity payment of $67,000 a year. Or he could do a 3-year GRAT with a payment of $363,000 a year if the payments are equal each year. Or he could do a 3-year grant or retained annuity trust with the first payment being $300,000 and the second 2 payments being 20% higher than that each year. So that's just a little shortcut on what could be done. The next thing that it has instantly determined is how a qualified personal residence trust may apply for this couple. So in the old days, 2 weeks ago, I'd have to go to the QPRT calculator and I would have to put in this information and make a determination. Now I have a shortcut. It summarizes he's age 70. There's an 85% chance that a 70-year-old will make it to 77, so we're going to do a 7% Cupid. The computer knows to do that. We're assuming he'll put half of the home in. His spouse will put the other half in one that she does, and we're assuming the home will go up at 3.75% a year. You will be able to adjust these percentages. You can't right now in this module, but within a couple of weeks you will. So here's the value of the home each year. There's the growth in the home each year. There's the ending value, and then if you live to age to the 7th year, there's estate tax savings. Now we're going to be adding the rent in, and if they have a dog and we add the rent in, we'll call the dog Rent 1010 or Rent in, Rent 10, or 10. Those of you who are lassies probably don't recognize the joke. Anyway, he could also put 100% of the home in, and we're running the numbers now, same numbers for 100%. Then Mary, quite contrary, could put her home in. Now with her age, her 80% survival number is a 10-year Cupid. So she puts in the Q. And by the way, for each of these, it says, look, you put in half of a 3,000,075 home. That's worth it 1,875,000, but the gift is only 1,018,000 for a 10-year Cupid. Yet it gets the whole thing out of your estate. So it's just a shortcut to show clients a Cupid. Now we'll probably add a joint and survivor Cupid. I've never done a joint and survivor Cupid, but I think some people have. So I'll remember to ask Kevin to add that. And then we can go into more detail on the self-canceling. Oh, I've got a couple questions. I'm sorry. Let me see. Sammy from Motown, Detroit. Perfect. Do you plan to split the IRAs between traditional and Roth? Judith, that's a great question. I think we will. Probably not too soon, but I think we will need to do that. And that's a great suggestion. Then also, does EstateView handle basis in determining tax? No, we're really mostly about estate tax. For the Cupid, we will calculate the capital gains tax on the sale of the home after the Cupid term in our calculator. I don't know that we'll do it in the quick start mode that I'm showing you now, but that's a great question. And I'm glad that Judith, Peter, Sam, and Carolyn are on the ball. Although one of them misspelled the word puppets. I won't tell you who that was, but the puppet's probably offended. Yes, I am. Very offended. All right. So then I'll go to the self-canceling installment note results. Oh, I showed you the summary, but it also lays out a sale for you. and it assumes this 70-year-old does a 15-year self-canceling installment note. He puts $1 million into an LLC. He sells a 99% ownership interest in the LLC to a trust in exchange for a $700,000 note. He makes a seed capital gift of $100,000 because you need a seed capital gift. And on a 15-year note, the risk, the interest rate is going to be 8.1%. And you know, I was going to say you want him to die early because the note cancels, but you would never say that directly to the person. You would just say, yes, I know you want your parent to die early, so the note cancels. And they say, no, but it's unfortunate that he's going to die early, but it's helpful that the note cancels. That's a tactful way to put it in the funeral discussion. But in any event, it shows the result of that. And then it shows a self-canceling installment note for the spouse and a longer note because of the longer life expectancy, a lower interest rate because of the longer life expectancy. And then it shows a joint and survivor scheme. Now, we used to have to hire Jerry Hesh to sketch all this out in hand with all the math. And poor Jerry, he'll have to survive on his royalty check now. But in any event, a joint and survivor scheme, when you do a self-canceling, when you do a sale for a note and the client says, well, I'm not sure that I want to live on 4% a year. Could you give me a little bit more? Well, this couple, you can give them 6.1% a year, and the term of the note is going to be 22 years. If they both die within 22 years, you've helped things. And in the meantime, even if they don't die, you're getting the estate down. Now, there will be a column for estate tax savings. So we'll show you the estate tax savings. But anyway, that's the self-canceling installment note calculator. Now, another question, Stuart, and thank you for attending, Stuart. And I know you can spell the word puppet, so I'm going to go ahead and answer this. Can you add an RMD calculator for inherited IRAs? Yes, we will, because people keep asking for that. And whatever people ask for, we give them sometimes. All right, so that's now, what about a private annuity? So a private annuity, even if I'm in terrible health, I could give $1 million to the trust in exchange for the right to receive $67,000 a year. And if I live at least a year and a half after that, or 2 years after that, and I die, I'm presumed to have been healthy enough to make that transaction. And the estate tax savings at a 40% estate tax bracket would be $406,000 if I die in year 2, $409,000 if I die in year 3, based upon me putting $1 million into an LLC and selling the 99% LLC interest to the trust in exchange for the right to receive $67,548 a year. The technical rule is, as long as there is no physical condition that has better than a 50% chance of killing me within 1 year, besides keeping the cabinets open all the time, that I can do this and it can work just fine. Now, you're going to say, what is the exhaustion test? The exhaustion test says that this trust would have to have a value of $2,248,000 in order to satisfy the Treasury regulations. And by the way, even if the person lives a long time, you haven't caused any estate tax because of the discount you're using. And I know I'm flying through this, but when somebody is in bad health, you consider a self-canceling installment note or a private annuity to a grant or trust. And I'm just really happy that Kevin has this, how fast these numbers come out, so that I don't have to go to a calculator and manually enter in the calculations. So that's the private annuity. So then I go to the grantor retained annuity trust. Now, a grantor retained annuity trust is an arrangement where I make a transfer of assets to the grantor retained annuity trust, and it basically gives me the money back over a period of years, and it's pretty much amortized at the 75/20 rate, which is 120% of what midterm treasury bonds sell for. It's about 4.4% right now. So I put $1 million into a 2-year grantor retained annuity trust. It pays me back $533,248 a year for 2 years. And if the assets grow at 7.5%, at the end of the second year, the remainder interest has $49,000, which is out of my estate for estate tax purposes, even though there was only a $1,000 gift made in setting it up. And if I had used a discount, which is hard to do in a 2-year GRAT, then it would have been more. Now, this is just the beginning of what we call rolling GRATs. A rolling GRAT is where I put in the $1 million, and then at the end of year 1, I get my 533, which I immediately put in the new GRAT. And then at the end of year 2, I get 533 from this GRAT and 200 and something from the second GRAT, and I immediately put that in a third GRAT. So my assets are always underneath GRATs, and the growth is limited to whatever the 75/20 rate is. And we have a rolling GRAT calculator, and I will ask Kevin to make this into a rolling GRAT demonstration up to the client's life expectancy, so that we'll be able to instantly see the result of $1 million in a rolling GRAT versus $1 million in a skin or an installment sale, which I'll show you in a minute. So I'm quite excited by how much time this is saving. And then I can show a 5-year GRAT with a discount, and I want to make sure I add the discount, because with a 5-year GRAT, you could take S corporation stock or a partnership interest with a good cash flow and pretty much value it so that the cash flow from the entity would pay the payment on a 5-year GRAT or a 7-year GRAT. And then at the end of the GRAT term, the entity interest is still in the GRAT. You can see how excited I am by that, because the numbers can just be fantastic. And then I show a 10-year GRAT. And look, with a 10-year GRAT, again, you've made no gift because you've pretty much put the asset in the GRAT in exchange for this amortized payment back. And if it's a 10-year GRAT at a 4.4% rate and the assets are growing at 7.5%, there's going to be $281,000 left at the end of the GRAT term without any gift tax use. Now, we can go ahead and put a discount here. I think I'll ask Kevin to show a discount. Probably on a 10-year GRAT, I'll use a 20% discount. And then the payments don't have to be equal. It's better that they start low and they go up by 20% a year. So that's what we'll be doing in the next 2 or 3 months. But for now, this certainly shows the attractiveness of a GRAT. So now I'll go to married comprehensive. Now, married comprehensive, if you've been married, you know that it is comprehensive. I think that's a joke I've never said before. So I click on married comprehensive, and what it does is it takes all the information that I've given it and a lot of assumptions, and there will be a later page that says, here's your assumptions. And with this, it tells me that if they die this year with no planning, then the estate tax will be $3.3 million, and the beneficiaries will receive $33 million. And that's just a matter of adding up the assets, 1-year growth. On the other hand, if we do some planning and we put all the different things in that we would normally do for this couple, and they're charitable, then instead of $3.3 million going to the estate tax, you would have $4.7 million going to charity. Now that's assuming no growth, but making annual gifts, doing an installment sale, and using a life insurance trust, which won't help in 1 year. And I'm going to show you the mechanics of these things, but it does cut the estate tax back, and then charity gets paid instead of the IRS. Now, just to show you, I could go back to charity. The people may say, we don't want to give to charity. So I could go back to charity, and I could click no on charity, and then I could go back to results, and let's see if it fixed it. Nope. Okay, so Kevin's got to fix that too. Pretend you did not see that this went to charity. Okay, now if they do no planning, and this is based on a 7.5% rate of return minus 0.4% a year for investment advisory fees and 2% a year for income taxes. If they do no planning, then the first death, year 21, they'll have 100 million of investments. And by the way, I have them saving money each year in the input. So that's part of the reason that they're going to have so much. And then on the second death, in year 27, they'll have 142 million of assets and $48 million estate tax. Now, their saving rate makes a big difference. So let's see what I put in here for savings rates. Got their names there, and then I had their CPA's name. I'll remove that CPA. She didn't do a good job. So then I had their children information, and then I went to their savings. That's where it is. So I had him saving 250,000 a year until age 70, and then I had him saving 100,000 from 70 to 80. Maybe he'll start spending 200,000 from 70 to 80, and then 80, maybe his spending will go down. And this is maybe his pension and Social Security will cover everything, or maybe not. So maybe he'll be spending more, and maybe she'll be spending more too. And the way this works is we use his numbers till he dies, and then we use her numbers. So I've got him spending more now, so I can go back to results and see if that changes much. And it changes a little bit. The estate tax is way down. You see the investments are down. So one thing EstateView allows you to do is just show clients how much money they're probably going to accumulate in a very simple way. Now, we also assume that on the first death, there will be a credit shelter trust. And our formula for this right now is the amount that would be the estate tax exemption, and we're assuming the exemption goes down to half in 2026, but we'll have a button where you can decide if you want to do that or not. And then we're assuming that the bypass trust will be funded to the extent of the lesser of half of the assets or the exemption amount. And that brings the estate tax down from 38 million to 35 million. Now, you don't always want to fund a credit shelter trust, because on the second death, the assets in this bypass trust will not get a new income tax basis usually. So there will eventually be a button where you'll be able to say, do I do bypass trust or do I, and then pay capital gains tax on the second death? Or am I better off with no bypass trust and using what they call the portability allowance, which is similar to a mushroom, but a little bit different? So that's the bypass trust. And then we show a qualified personal residence trust if there's one or if there's two. That automatically spits out. It's using the same numbers that I showed you before. So you can see that by the second death, you put in a $3,750,000 home. It's about a $2 million gift, and you've got $7,700,000 out of the estate. That's worthwhile. A big part of that is because of the rent they pay during the term. So the estate tax down to 28 million now. And then we go, what about annual gifting? So we see that they have 4 children, 72,000 a year. And then with annual gifting and the amount of children that we loaded in here and grandchildren later, 6,700,000 in the gifting trust. So that annual gifting is worthwhile. Then if they gift discounted limited partnership or LLC interests, they'll have 9 million. That assumes a 30% discount. And then if they want to do life insurance planning, we'll show life insurance savings or loss. Because if you pay a big premium to a life insurance trust and then you die after your life expectancy and you've used the life insurance trust for your withdrawal power rights, then you actually could come out behind, but you could have also more liquidity. I went to a bar last night with Marcia and we had some liquidity. Okay, then that's not to encourage anyone to drink though. We drank club soda. So then how about a large gift? So we're at 24 million and we have the computer gifting 1/3 of their investments. So their investments you see were 29 million, a third of 29 million is about 9 million. So that, I thought, Kevin, I guess it's 1/3 of the non-IRA investments that they gift. So now you see that gifting trust starts at 6,800,000 and ends up at 49 million. That large gift of 1/3 of their non-IRA investments brings that estate tax down from 24 million to 12 million. So, and if we use a discount, it'll be greater. I'll talk to Kevin about what discount we're using there, but this certainly shows that. Linda, will your program show the total tax, including generation skipping tax? No. One of the reasons for that is very few clients pay generation skipping tax. I'm going to take it for granted, like Mary Tyler Moore, Mr. Grant, that they're not going to have a generation skipping tax. But the real reason is it's just too hard to program that right now. We haven't gotten to it. First, we're going to have to do New York and Massachusetts state estate taxes and things like that. And then the puppets want to have a puppet calculator. That's going to take some time. Capital gains tax, I'm sorry, we don't show that yet, except on the qualified, we show that on the qualified personal residence trust calculator. And capital gains tax we do cover under the charitable remainder unit trust. But thanks for that answer, that question, Linda. Now, the next thing we could do is we could put 1/3 of their investment assets, about another 7,500,000, into an LLC and then sell 99% of the LLC interest to the trust for a $4.7 million promissory note, paying $210,000 a year for his life expectancy. And at the end of year 21, that trust is going to have 16 million in it now. So that's pretty darn good. And then at the end of year 27, it's going to have 22 million. So as opposed to the gifting, which gives you 49, but uses 7 million of your exemption, the installment sale gives you 22 and uses almost none of your exemption. But we should be showing the impact of both the large gift and the installment sale. So I'll talk to Kevin about that, because I think now we're just showing the large gift or the installment sale. We'll double check that, and I want to thank you for being beta presentation testers. And then finally, we go to testamentary charity. I really like testamentary charity because I run into a lot of families that are going to pay estate tax, and when I explain how a charitable lead annuity trust works, they say, yeah, I'd rather do that. So let me see how that's working. So I'm going to say charity, yes, and I'm going to say charitable lead annuity trust, and then I'm going to go back to results, and let's see how it did, see if it's working. It's not, but you can use your imagination that instead of 3.6 million going to estate tax, he's got 9 million going to charity. I'll have to double check that numbers. It seems high. So the kids have lost 5 million, but they have a $9 million charitable foundation they can operate. Now, with a charitable lead annuity trust, they will have 9 million going to the charitable lead annuity trust. It will pay charity over a term of years. And then at the end of the term, whatever rate of return above the 4.4% 75/20 rate has been received goes to the children. So they end up with more. And I'll show you how that works in a minute or two. So now, this is far from perfect, and a good conscientious tax planner will make some adjustments, but this is very darn informative, and only took, literally 4 minutes to set up. I'm going to click on generate client letter, and now there's a bunch of squirrels writing this letter, and there it is. Wow, Kevin, it was fast. Good job. So I'll share this letter with you. We got it, like the box tops. My baby wrote me this letter. She wrote me a letter about my estate tax. I forget, we'll have to do a parody on that. But anyway, this letter explains what we just did. And it also gives you all the assumptions that we used. And then it provides the client with, the same pictures, but also the explanation. It's not as extensive as the married couple full letter. We might make it more extensive, but that is what the letter does. Now, let me see if I can share this letter with you. If you could just hold on a second, I'm gonna try to get this letter into an email format. Where did it go? Where are you, letter? There it is. And now I'm going to post it into, where do I, aha. Download it, see if this works. I'm doing this without, yes. No? No. I thought it was yes. All right, well, later I'll email you. Oh, there it is. I'm sorry. I'm gonna put that letter in there while you check your emails and your texts and yell at your children and walk your dog and your cat. And, well, next week I'll know how to do that. Let me try one more time. There it is. All right, so it's in your handouts now. Okay. So now what I do, and you're going to like this if you've been using EstateView, is I click Save to Calculators, and then I can do one of two things. I can overwrite what's existing in my calculators now. It'll replace what my calculators have, or I can append to existing, which means if I have 1 or 2 calculations in there, this will become 2, 3, 4, and 5. I'm not sure how it's going to work yet because it's not working yet, but it sure looks nice, doesn't it? So save to calculators and overwrite existing calculators, click save, and now I'm able to go back to the software, to the other parts of the software. I've just shown you everything we have now under the instant plan. I'm really going to appreciate your questions and suggestions on instant plan. During this conversation, I've had a few ideas that I've shared, and Kevin will be watching this video and saying, oh, we got to do that, we got to do that, we got to do that. Okay. He's going to pretend he likes the ideas. Other questions? Does the program calculate the benefit of paying gift tax? Alan, not yet. I have a question for you, Alan. have you had a client willing to pay gift tax? Now, it is worthwhile to pay gift tax, because if I give a $10 million gift and I pay a $400,000 gift tax, and then I die, my estate is lower by 14 million, and my children end up with more. But I haven't found the client yet that was all got crazy about paying the gift tax. Secondly, from Judith, she says, this is a mundane question. How do I reduce the black column to get a full page on the screen as your example? I don't know. I can't do that. We'll have to ask Kevin if he can do that. Otherwise, right now in the instant mode where I was, you're stuck with the black stuff on the left. Now, Kevin will make it so you could change it to any color you like, but right now it's that NCNB black. We should really make it blue, I think. Linda says, did you or do you have a list of all the various types of trusts, like a glossary, and the pros and cons of what situation they are used? No, but Lineberg has a great book of trusts by Ed Morrow and Paul Hood. But I should have my law students who work here. Actually, they're not mine. I would not claim them. But, and then Alan said, yes, he has had clients pay gift tax. So we will do a gift tax payment savings calculator someday. All right. So let's go back to the married couple calculator, because if you've been watching this, then I can call you George Washington, since we just had a presidential election. And we can be a little bit more specific on some of these techniques. So when you go to married couple, now in the future, not today, but very soon, when Kevin fixes the button, when you click on Save Settings to Calculators, this calculator will have all those same settings. And this calculator is better in some ways, but not as good in other ways as the format I just showed you. One thing is, with this calculator, we're very restricted as to the size of what we can show. So we're going to be able to have explanations down below this in the in the new one that we really don't fit here. This one, and I'll talk to Kevin about this, this one shows a timeline. So for example, I'll go down to planning after a bypass trust and a qualified personal residence trust. I click there and it shows me, sorry about this, it's the fit width is not working beautifully today. So it shows me the Cupid, it shows me the bypass trust, and it shows me what happens in years 21, 27, but I want to know what happens every year. So I click on timeline, and it shows me a timeline which shows me each of their categories of assets, and the Cupid, what it's worth, and the red estate tax. And I really like this because, for example, if I go to installment sale, while there's very little tax there, and I can crank this up to show you that I can increase the installment sale to where there's no tax when they die. And that's the way it looks. And you say, wow, that installment sale was fantastic. There's no tax. Well, what about the timeline? Well, oops, there's no tax, but you got to live that long. So we'll talk to Kevin about putting the timeline button into the first module that I showed you. The instant plan is what I think we're going to call it. I'm waiting to hear back from the intellectual property lawyer as to whether that works. So anyway, I was able to just take what the instant plan did, which was a 1/3 gift, and then adjust it up. So I'm going to talk to Kevin about whether the computer, and we'll call this artificial intelligence, but it's just spreadsheets, whether this programmed spreadsheet will be able to say, well, if I give 1/3 of my non-IRA by gift and see he's not using a discount. So if I want to go to large gift and I see that a 6,000,008 gift brings the estate tax down to 13 million. But what if I use a 30% discount and it uses less of my exemption? Well, that's going to save a little bit of estate tax. Or what if, so you see 11 million now, but if well, let's go to no discount, 6 million, now it's a 13 million tax. What if I put 6,000,008 in an LLC and take a 30% discount, transfer a 99% interest? That brings the tax down to 11 million. But what if I put 9 million in an LLC or 9,000,008 in an LLC, call it a 6,000,008 gift? That brings the estate tax down to 5,000,008. So now I go to installment sale, and how much of an installment sale do I need? And maybe what we can do, Kevin, is assume that the client, if they're large, is willing to put up to 1/3 of their non-IRA assets into a gift trust with a 30% discount, and then handle the rest of the estate tax with the installment sale. And that may be, fairly automatic. We'll have to have levels. People like Alan, who is asking some great questions here, can be very helpful in what the standard of practice should be, what the automated guess of our computer would be as to planning. And then I want to show you Charity, because it's one of my favorite calculators. So without Charity, well, let's turn off the installment sale calculator. Pretend there's no installment sales. You know that John Lennon song, Imagine There's No Installment Sales? Uncheck that box. Okay, and then I'll take out, where am I? There should have been estate tax at that point. So let me also take out the large gift. Large gift, gone. Now an estate tax of 12 million. Children get 81 million, that's not bad. But if I go to all to Charity, and I click on Charity, and I've just got a Charity there, now the foundation gets 31 million, and the children only get 62 million, and they've sacrificed 18,940,000. But if I use a charitable lead annuity trust, and I'll click here to charitable lead annuity trust. Who here had the album The Who Live at Leeds? That was named after a charitable lead annuity trust that Queen Elizabeth III had done in the early 1960s. How many people believe that? Okay, you're right that I'm wrong on that. But anyway, if you assume that half of the CLAT will go to charity over a period of years, and half will go to the beneficiaries, now the beneficiaries sacrificed 3,000,001, and the charity gets a lot. But this isn't showing present values, and pretty soon Kevin's going to have this also disclosing the present values. So that's a charitable lead annuity trust. Now the other alternative is we go with a charitable remainder trust. And this is where the charitable remainder trust is nice. If, let's say that these people have a $4 million IRA, and instead of the IRA coming out over 10 years, they want it to come out over 20 years, or even over the life expectancy of a younger child. So they want it to come out over 30 years. And they use the minimum portion that could go to the child, 10%, or I'm sorry, a small portion going to the child. Anyway, you're going to have an estate tax savings and the stretch. And I just completely botched that description, but you can believe me that it works nicely. I didn't realize that this was going to take an hour. I had a lot of slides I was going to share. I can do them next week. I also just wanted to mention that one of the things that I'm excited about is that this new instant plan is also going to work well for the retirement calculator, and especially for married couples and single individuals that don't have so much estate tax exposure. What we need to share with them is, do you have enough to retire, and will your children have enough to retire? So we'll also be populating our needs estimated savings tabulation analysis known as NEST, and it will show the person, based upon what amount they want to be able to retire on, whether they're ahead or behind, and what they'll have to do, how much more they'll have to save to get ahead or behind. And then it will also say, by the way, if you die right now, here's how much life insurance you have, and click here to figure out how much it's going to cost to add it, and then it will automatically be added under your reoccurring expenses. So stay tuned for that. Right now it shows REC expense, but that's going to be life insurance premium expense the next time you see it. Thanks again to, oh, by the way, if you go to, and let me see if we have that, just so you know. If you go to EstateView, EstateView.info, you can click on our video library, and we have a video on each of the calculators. And we're always updating the videos, but this is free of charge, and I find it to be very educational. And let me just see if there's one more thing, because everybody's hanging on here. I wanted to show you, for those of you, Alan, stay on. Have you considered this? So you have a very conservative client, and they want to give 20 million, and they want to take a 30% discount, but they're very afraid that the IRS will not allow them a 30% discount, and that they'll end up having to pay federal gift tax, even though it can be helpful to do so. So what I'm going to do is I'm going to put the 20 million of assets in the LLC. I'm always going to wait at least a month. And then I'm going to have them gift 64% to an irrevocable trust, a spousal limited access trust, or a dynasty trust. Now, we're going to report that as not a $12 million or $13 million gift, but as a $9 million gift. We're going to take a discount. But if the IRS looks at it and completely disallows the discount, then the clients only use 13 million of their exemption. There's no gift tax risk whatsoever. The other 35%, I'm going to have the client gift to a lifetime Q-tip trust. Now, a Q-tip trust is a trust that pays all income to the spouse. And when you do a lifetime Q-tip trust that would pay Marcia all of the income, I can do what's called a formula election. And I can elect to have a portion of that trust be out of my estate and not qualify for the marital deduction, and a portion of it to qualify for the marital deduction. So I make a formula election, which says this will qualify for the marital deduction to the extent of the minimum amount needed, so that I have no gift tax liability. So if the IRS accepts or doesn't challenge my 30% discount, this will all be out of my estate when I die. It does have to pay income to Marcia, but it could invest in low dividend stocks or real estate or vacant real estate, things like that. Or if the IRS says you get no discount at all, then it'll all qualify for the marital deduction, and she could pull it out and we could do something else with it. Or if the IRS says you only get a 20% deduction, then a portion of this trust will be outside of the estate tax system and be cordoned off, and the excess will go to a separate marital deduction trust that you could pull out. So when you get close to the end of next year, if they haven't fixed that 2026 reduction, I think a lot of people will be using this technique. So at least I got to show you one technique from the PowerPoint slides. I would love to do this next week. If you have any questions, you do have my email address. It's agassman@gassmanpa.com. And those of you who are EstateView subscribers, thank you very much for your support and for your patience as we get all this figured out. Have a fantastic, excellent, and wonderful rest of your day. Thank you. Bye-bye.